Hey, what's up everybody? Alex here and welcome back to another video. And in this video, we're going to be talking about the main reason, most likely, why you're not getting qualified for a mortgage loan. So getting qualified for a mortgage loan is really simple. Yeah! It's not too difficult. I broke down the 4 things that, as a mortgage lender, what we look at to get you pre-qualified in another video. I'll link that down below. But in this video, I'm going to talk about the one thing that's most likely holding you back from your qualification. Now, one of the most important aspects of getting qualified for really any loan, whether that's an auto loan or a mortgage loan, is your debt to income ratio. Your debt to income ratio is a formula that the lender will run to assess your affordability of the thing that you're buying, right? Or the loan that you're getting. Because the thing is when someone is giving you money, their number one goal is to make sure that, okay, we need to assess that you're going to give us our money back, right? So it's a very simple calculation. It's what they do is they're going to take all of your monthly debt obligations. Now, they're not going to take, specifically in a mortgage loan, they're not going to take your rent payment. They're not going to take your Netflix or your gym bill or even your phone bill. What they're going to do is they're going to take anything on your credit report. So things like auto loans. Now, if you have an auto loan of $500, let's say, and you're paying $800, they do not take the $800 payment that you're actually making. They just take what's on your credit report or the minimum payment. So auto loans, which is an installment loan, they're going to take the minimum payment. Credit cards, they're going to take whatever the minimum payment that is being reported to the credit report from the creditor that you have the credit card with, right? Now that's going to vary depending on the balances that you have, but typically the nice thing about credit cards is the payments are relatively low in comparison to an installment loan. Other things that are pretty popular that hold people back are student loans. So I'm going to quickly touch on what we do to qualify you if you have student loans. Now, if you do not have a student loan payment on your credit report, so when they pull your credit report, and let's hypothetically say it says 0 or a question mark. If there's a question mark on there, we have to take, depending on the loan program, 1% of the balance. If we do a conventional loan with loan processor, which is Freddie Mac, then what we can do is we could actually take 0.5%. But if it's a Fannie Mae conventional loan or an FHA loan or USDA loan or any other kind of loan out there, typically they're going to take 1% of the balance. Now what we do is we take all of these payments on your credit report, add them together, and then add it to the new mortgage payment that you're qualifying with, right? Now, this new mortgage payment is going to be your total payment. It's not just your principal and interest portion. It is your principal and interest. It's your homeowner's insurance. It's your mortgage insurance. If there's an HOA, they're going to take that in consideration. If there's mortgage insurance or any other kind of thing that's added to your mortgage payment, they're taking the full monthly payment. Then, once you add all of your debts and your full monthly mortgage payment that you're buying, they divide that by your gross monthly income before taxes or deductions, okay? Very, very simple calculation. The reason I'm telling this to you is because if you are looking to purchase a home in the next 6 months or 2 months or whatever, this is a very important calculation the lender's going to run to make sure that you can actually afford the home that you're buying. So now that you know how to actually calculate your own debt to income ratio, I'm going to kind of tell you what some loan program requirements are. So conventional loans, you have to be under 50% debt to income ratio. If you're doing an FHA loan, you have to be under 56% debt to income ratio. If you're doing a USDA loan, you have to be under 43% debt to income ratio. And if you're doing some sort of down payment assistance, they're typically going to follow FHA, so it's also going to be 56. So if you're going to do the last one I can think of off the top of my head, it's VA. Now the cool thing with the VA loan, and I know this video is not talking about VA loans, but the cool thing about VA loans is they're a lot more lenient on that debt to income ratio. There really isn't really a limit. It just takes whatever your underwriting system is going to take, or whatever the lender's underwriting system is going to take. So a good rule of thumb, take all of your monthly debt obligations, add it to the new mortgage payment, divide it by your income, learn what your percentage is. You guys can self-assess on your own now. Please, if you found this valuable, like, share, subscribe, turn that little like button blue down there. Much appreciated. And I'll see you guys in the next video.